Let's see. Should I move?
Yeah, I don't know. There we go. That's right. Got to get the Bitcoin artwork. Whoa. See, David, now this is a proper background.
Oh, wow.
Incredible.
Very cool.
But Robert has such a good setup. You've got like the HD camera, you've got the multi
You've got
color
like the
lighting.
you've got like the podcaster setup.
I'm head of multimedia at a media agency, so I kind of have to have this.
Kind of
I'm
have
also
to, yeah.
I host a daily show, which you guys are welcome to come on, by the way. So yes, I kind of have to have all this stuff.
Is
I
the
would
focus of
join
your
if you
show
helped
Bitcoin?
advise me on my lighting situation here. Because
Ooh,
this
I
is
can
not
always help.
Trade.
it's not ideal.
Yeah, I can help. It's easy. 3-point lighting setup. That's all it takes.
Amazing. Yeah, you've got the warm and the cool going on. This is wild. This is next level. Joey, you should be taking notes. Your LinkedIn followers
So
would love
annoying.
this.
This is so annoying. Oh my God. David, Robert works for this little company called Cointelegraph. You may have heard of. So
I have heard of Cointelegraph.
Yeah, unfortunately not Bitcoin only, but that's not my fault.
Yeah. Well,
well,
You got to pay the
Oh, well.
bills. People love the alts.
We have a massive audience that I can preach Bitcoin to, so
Yeah,
doing
there you
something.
go.
there you go.
amazing.
Arguably, more important.
So guys, we've got Ian, how do we get things moving?
I think we can start now, but I don't know how to start this because I'm not the producer. Can we just? I'm getting messages on the side. Can we just go? It's already started. We've soft launched.
Very good.
So let's just get into this. For anyone that missed the rambling 45 seconds before this, my name's Rob. I'm head of multimedia at Cointelegraph, and I'm joined by 3 esteemed guests, Joey Garcia of Xapo and David Zell and Connor Brown of Bitcoin Policy Institute, which I will now refer to as BPI. Look, before we get into this, I think you should probably introduce yourselves with a bit of a TLDR of what you guys do. Joey, I'll come to you first. What do you do?
So I'm one of the executive directors at Xapo, and I head up sort of policy strategy, if you want to call it that. Long history in the space that a lot of people may be aware of, but very much sort of involved in reg developments, really sort of around the world. So started working with Xapo back in the day, back in 2014, the concept of developing new frameworks, and took that through to working with lots of places and lots of things, including the UN, where I acted as a specialist consultant, helping sort of governments around the globe develop standards, and then obviously do a whole load of stuff in the US and the UK and all over the place. But yeah, been involved at the intersection of, let's call it, the rules, the financial services world, and the developing crypto ecosystem for a long time, and really keen to sort of get the key messages around that, especially from a Xapo perspective as a very much Bitcoin native institution. We always say this, and I'll say it very quickly. There are lots of banks that are exploring blockchain technology or Bitcoin as a concept, and we're the kind of opposite of that. We are a Bitcoin native business that's obtained a banking license, not a bank that's exploring funky new technology, and that's quite a big significant difference in understanding of the ecosystem on that basis. So anyway, long-winded intro.
I mean, it's interesting though, and also 2014, I think, easily qualifies you as an OG in the space. That is very early adoption indeed.
Well, I mean, back in 2014, if you started talking to platforms, and I've mentioned this to David and Connor before, if you met a government authority or a regulatory authority in 2014 and started talking about virtual assets, they literally thought you were like a criminal. And some of those original working groups, they would send like, police officers and stuff to attend those meetings. It was a very, very, very different world.
Wow.
You can get a meeting anywhere, let alone a law firm in London or New York or anything like that. And now it's kind of a bit the other way around. So yeah, been an interesting journey.
Wow. Yeah. I mean, even when I joined the space in 2017, I was meeting with pretty big companies that everyone would know, and they would only meet with me and talk about these things if it was off the record. They wouldn't they wouldn't go on the record. Very interesting.
Yeah.
We've come a long way at least.
Yeah.
Connor, how about you? What do you do?
Yeah, so hey everyone, I'm Connor Brown. I'm the managing director at Bitcoin Policy Institute. My Bitcoin journey is a little bit roundabout. So I fell down the Bitcoin rabbit hole when I was in law school in 2018. and couldn't figure out how to work on Bitcoin. I went to a law firm. I was working in financial restructuring, so companies going through bankruptcy, and just really, really cared deeply about Bitcoin. Couldn't quite figure out how to way to make the professional jump, and then was able to work actually at a fintech and blockchain practice at a law firm here in Washington, D.C., where I represented a lot of the different coins on the sort of top 10 coin market cap from investigations by the SEC. And that was a sort of eye-opening experience. I was frontline to Gensler's sort of war on crypto and a hostile administration. And by luck, I happened to get a connection to Senator Lummis's team. They were looking for someone that really understood Bitcoin and artificial intelligence policy. And it was sort of right place at the right time. And I made the jump over to Capitol Hill. I'd always had this view that the policy questions and discussions around Bitcoin were just not understanding the scale of the question Bitcoin poses. Yes, there are financial regulatory issues. Yes, there are updates to all sorts of different arcane rules that were made for older legacy systems. But the most interesting and exciting questions around Bitcoin are the questions that it poses on a 5, 10, and 20-year time frame of what does this mean for a new emerging monetary order, and how do we educate policymakers to understand the gravity of the situation and start coming up with novel ideas to position themselves successfully for Bitcoin. And that was when I got in touch with Bitcoin Policy Institute. I was working on the Hill. I was helping Senator Lummis with legislation, and I kept finding myself needing sort of who are the best experts I can turn to put together the case for Bitcoin at the highest levels and explain it with credentialed advocates. And so that's how I got to know David. I just sort of accidentally invited him. I got connected sort of accidentally to him, invited him to come speak in the Senate. And, that started our work together. And then about a year ago, after a couple of years in the Senate, I joined BPI full time and now, oversee several different parts of the organization, our policy work and our different programs. So that's the quick rundown on me.
Amazing. I think a lot of us found our way into Bitcoin by trying to work out what we could do that would be useful to Bitcoin, and unfortunately I didn't end up quite in higher places as you. I just yap about it for a living, but it's still it's just trying to find that window into Bitcoin. Once it gets into your blood, there's no getting rid of it. David, what's your story? What do you do?
Yeah, so I'm the co-founder of the Bitcoin Policy Institute, and my credentials are frankly self-referential. I didn't do too much before this. I have one claim to OG status though, which is that my first Bitcoins were purchased on by meeting up with someone in rural Alabama from local Bitcoins, like way back in the day. Unfortunately, I was spending those coins, not investing in them. I was too young, I think, to understand the value proposition of Bitcoin. But I had a first touch point with the protocol basically when I was in middle school. And then later in high school and in college, I really went down the rabbit hole. And just like kind of what you were talking about, sort of wanted to figure out how I could do something useful for Bitcoin. And so in 2021, I was working at Bitcoin Magazine. And you might recall there was this infrastructure bill wherein a last minute provision was proposed that would effectively ban, to the extent the government can ban, self-custody. So it was sort of banning, essentially all sorts of kind of key ways in which you would interact with the Bitcoin protocol. And I found that to be like really surprising because my understanding was that there were sort of no shortage of very expensive white shoe lobbyists in DC pounding the pavement for Bitcoin. And so that just felt incongruent to me. It was like this industry as a whole, crypto, is spending records amounts of money in DC, and they're getting hit with like last minute bills that are almost existential and kind of came out of nowhere. My background was really in sort of advocacy. So I had led sort of campaigns that were successful in the southeastern United States, sort of doing anti-private prison build-out work. So I'd had experience kind of doing policy advocacy, kind of campaign organizing. Um, and so I sort of started to investigate like what's actually going on in DC with respect to Bitcoin. And very quickly, I identified like two major gaps. One was that, yes, there were a lot of crypto organizations, a lot of crypto lobbyists, but there was really no one in DC who was Bitcoin only, who was actually sort of making the strongest argument for Bitcoin, which is that it's fundamentally different from every other cryptocurrency. Every single person who was kind of acting in the DC space kind of had a strong incentive to downplay that and to sort of ride the coattails of Bitcoin when convenient, but then distance themselves from Bitcoin when the inconvenient questions on things like energy use came up. The second gap that I noticed was that no one in seemed to be, or very few, I don't want to say no one, but very few people seemed to be taking Bitcoin all that seriously. Like they were super indexed on the Bitcoin of 2021 and the immediate questions that it posed for tax, for financial regulation, for financial services. Um, no one seemed to think that, Bitcoin had any real chance of moving past that, which I think is like this common recurring uh, uh, sort of bias in Bitcoin, which is that at every point in its history, people sort of mostly write about and think about the network, assuming that it's just done growing. And to me, the most fascinating question was, well, what happens if Bitcoin 10x's from here? Or what happens hypothetically if Bitcoin were to reach, parity with gold? Well, all of a sudden, the policy challenges, the policy questions kind of, you know, go from sort of minutia to literally like grand strategy, national security, questions of sort of fundamental statecraft. And so seeing those two gaps, I thought, wow, DC really needs a think tank for Bitcoin. And so now BPI is in its fifth year, and we've got about 12 people on our team. We have a sort of academic network of about 24 fellows, and the principal goal of BPI is sort of research, education, and advocacy that sort of helps lawmakers in America understand why this open, permissionless monetary network is actually sort of in their interests. And so, in turn, kind of pushing for a public policy regime that is, maximally kind of laissez-faire and respectful of individual rights and civil liberties. And so it's this thing where we've seen time and time again in American history, whether it was like, the internet being a great example, of these technologies that, emerge that on some level do take power away from the state, but wind up having all of these benefits that outweigh that sort of degradation of control. And so a lot of what we do really is trying to help policymakers who see a scary thing in Bitcoin. They see, anyone can move money anywhere without permission, without censorship, and try to explain why they shouldn't be scared of that, which is a fun but often arduous task.
There are an enormous number of threads that I want to pull there. But one of them, I think it was your first point, is really the essence of today's conversation. I'm going to put this to Joey first. Us Bitcoiners, we say Bitcoin, not crypto. It's almost a cliche to say it at this point, but it's not a frivolous distinction. We're not splitting hairs here. There is a very serious difference, and there are a lot of knock-on effects of conflating the two. So, Joey, how would you explain to someone why it's Bitcoin, not crypto?
That's a good question. Something we like to talk about a lot. So I think to kick off answering your question, one of the problems that we see in the industry, and I think around the world, is that if you speak to people, let's sort of higher up the Richter scale, policymakers, regulatory authorities, Google, whatever it might be, correspondent banks, they tend to sort of bracket everything under one radar. So it's a virtual asset. You sit in one block, not just on an asset basis, but also on an activities basis. So, we're a bank, we offer exposure to BTC because we believe in the longer term mission, and the value proposition is a safe way to protect, store, and grow your wealth. And we think Bitcoin is part of that journey. Doesn't really matter. We're often basketed in the same case as a highly leveraged derivatives trading platform or some staking network or whatever it might be. It's all the same thing. It's all the same assets. It's all, and we've tried, many people have tried, trying to develop accurate sort of frameworks that distinguish them. But to answer you specifically, if you're really put on the question, put on the mic and said, what's the difference? There are some like really sort of core fundamental differences. And I think the most core one for me anyway is true decentralization as a concept. So, you were saying before, Robert, you were saying, oh, I'm a small voice piece and I do this, and David's doing X and Joe's doing Y and Connor's doing the other. The reality is that the Bitcoin ecosystem is like millions of spinning wheels all trying to push things towards the same mission and goal. But there is no sort of policy unit. There is no CEO. There is no marketing team of the Bitcoin network that's doing X, Y, Z. So that core fundamental concept of an open network, a decentralized, open, immutable network, it's also not fully understood, and everything is bracketed in the same way as the same thing. So sometimes we'll say, will the future of finance be built? Will the competition for the internet be developed by a series of intranets that come onto the network or extranets that come onto the network? We don't think so. And time has told this story many, 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 many times. If people are talking about, blockchain as the future, and they're talking about real world asset tokenization, or they're talking about equities being tokenized to be traded more efficiently, I mean, that's all wonderful sort of problems of efficiency. And of course, it adds to that, but it doesn't keep the fundamental sort of core value proposition of an open, immutable network of data that is not subject to any singular control. And that is a core message around the Bitcoin ecosystem and what it is and what it's built to serve. I mean, there are lots of little bits that you can add on to that. Obviously, the fixed and transparent supply is super relevant. The proof of work is that sort of physical anchor to the security, the track record, the separation of money from the state, if you want to call it that. So it was really designed so that no government could unilaterally kind of inflate or confiscate or freeze it at a protocol level. And that's not a feature of all assets. Most or 99.9% of virtual assets are subject to singular human control, oversight, and functions and features that ultimately, and we can give many examples of that, and that sort of core separation of what it was built to do is also a pretty unique feature. So that's sort of lots of bots. I'm sure that Connor and David can add to that as well. It's a long and difficult debate, but it's also something that I think the community and everyone needs to start to understand in a bit more detail. We need to start migrating things away from, all virtual assets are created equal and all VASPs are created equal. There needs to be a deeper understanding from the community all the way up to the policy makers as to what those differences are. But Connor, David, what do you think? What would you jump out as core differentiators?
Yeah, I mean, I think the last point you made is that true equality is treating different things differently. If you treat different things the same way, then you are not properly doing your job as a regulator. And that is part of our job at BPI, is sort of explaining to regulators. Let's say, for example, they're currently discussing a disclosure regime for digital assets. They're saying that you need to disclose fundamentals about the protocol that are similar to stocks and bonds because of concerns about insider developments or things like that. The reality is that Bitcoin is very, very different compared to the vast majority of projects in the space, because it did not have an initial founding team that put it together, that did secure agreements for future tokens to themselves. It does not have a foundation. In the Caymans, it does not have a legal team or a marketing team. It doesn't have anyone to do the disclosures. And so if you are painting with a very broad brush on a policy framework, then you can actually gloss over extremely important distinctions between Bitcoin and the rest of the digital assets. Many digital assets can meet those disclosures. They do have a founder that can sign those disclosures. They do have information about the development team that is on payroll. Bitcoin has none of that. And making that distinction and making sure that any regulatory framework that's coming into place has a place for Bitcoin to sit as the open, neutral commodity that it is very important and is part of our day-to-day work. But to Joey's broader point of the open networks, I think this is like the fundamental unlock when we're educating people about Bitcoin is you can't see Bitcoin in this 15-year time span from the white paper. You have to view this in the context of networks generally and monetary history generally. And time again, we've seen that open monetary systems that have better monetary properties than their competitors simply outcompete closed or centrally controlled monetary systems in the long run. This is why we eventually went from primitive monies to precious metal systems. This is why every fiat currency has eventually collapsed, because it can't eventually sustain itself and it gets outcompeted by larger open monetary networks, the last of which was the gold standard, and now we're in this fiat currency era. But I think having that broad view and then seeing Bitcoin as this new chapter in monetary history, this new open network that we expect it will gain market share and competition because of its improvements, it's not something dissimilar from the rise of railroads, from telecommunications, from all sorts of different networks that America and the West has built out over time. In every instance, the reason those were successful is because they had an open standard. The internet had TCP/IP. The railroads had a certain way of building the rails so that multiple, different operators could use them. So I think that this is sort of like a long story that we're telling, and the education piece is really important to make the distinction between Bitcoin and crypto in a way that people understand the moment we're in and understand what makes Bitcoin unique, because it's very, very easy to just say digital assets as shorthand and miss the finer points.
David, before you jump in, I just want to sort of add another question on top of this, inspired by what Connor just said, really. I think when we look at Bitcoin is really see it as being designed in opposition to the system that was in place already. And now we're seeing kind of the adoption of Bitcoin by traditional finance, by the traditional banking system. But they run on closed, permissioned networks. Do you think Bitcoin can ever really fit into that world? Or will it always just be grafted onto the side? Because, as Connor said, that it doesn't fit neatly into these boxes. And can we adapt those boxes enough that it does seamlessly fit? Or are we just looking at a problem that needs perhaps a larger solution?
Oh, you're on mute, David.
Sorry. Yeah, I mean, I don't think that the integration of a technology or a financial asset that sort of structurally stands outside of traditional governance, or as you put it, in opposition to traditional governance. I don't think the integration of such a technology or asset into the system, as it were, is without historical precedent. I think the internet itself is a wonderful example of this, where in the early days, the internet was essentially illegal. At least in the United States, you had to have a .edu or a .mil domain, i.e. you had to be in the university system or the US military to legally use the internet. And up until the early 90s, commerce was illegal online. And so initially, policymakers were aghast at this open and permissionless system. And the only thing that could come to mind was all the terrible things people could do with this. That money launderers could benefit from it, that terrorist cells could use it for communications, that scams and abuse and fraud would run rampant on these new rails that didn't have referees or gatekeepers. Eventually, those arguments were drowned out. Those policies were changed. We let anyone connect onto the internet legally. We let anyone do commerce online. And the result was basically 30 years of meteoric GDP growth and stock market growth, where today the largest companies in the world are all companies that would have, on a technicality, been illegal 30 years ago. So I think Bitcoin benefits from that history, where there are technologies that you can point to that were similarly sort of outside the purview of the state, that once we adopted, wound up being excellent. And so I don't think that the sort of founding premise of Bitcoin, nor the sort of fundamental inability to regulate it. Like, it's something we talk about a lot, right? You can't actually regulate Bitcoin. The TikTok next block, there's really nothing you can do. But you can regulate users. You can regulate companies. You can regulate the people who are using this protocol. And so I don't think that that sort of means that Bitcoin will forever be in this sort of sidecar to the global financial system, or the global political economy. I think that, for example, when we had a gold standard, I mean, gold was an analog version of Bitcoin. It wasn't as useful or practical, but it shared these same properties of being a bearer asset, of being, quite private, of not requiring a proper intermediary to validate a transaction or to effectuate a transaction. And so, gold is a keystone part of the global financial system. Roughly half of the market value of gold comes from the demand from central banks, from governments who hold it. So in and of itself, that's a bit of a paradox. Like, gold is this, objective thing. The government can't really manipulate the supply of gold, at least easily. The government cannot trace people who pay each other in gold doubloons or bullion. You certainly can't undo a transaction in gold. If it's sitting in someone's vault, you have to expend quite a bit of force to do something about that. And yet this, this asset, which, today is kind of in some ways construed with crime. Like, for example, there was that senator in America, Menendez, who made headlines like last year when the police raided his house and they found, among other things, that he was holding all of these gold bars like under the floorboards of his house. And so the obvious implication from all of the mainstream, commentary was, well, he's a criminal, because only a criminal would hold gold, in their house. And so gold itself has this kind of connotation with the illicit.
Oh, have we lost David?
I think
he froze for me.
Point.
Yeah, he was right. We called him Gold Bar Bob. That was his name on the bill.
Oh, he's
Am I
back.
back?
He's back. Yeah.
Hey, I was just saying, it's funny because, gold has this connotation with criminality, with like being illicit, with being private. Yet it's like a keystone asset that's, purchased and held by every single government in the world. So yeah, I think there's a very natural place for Bitcoin. I mean, one of the main things we do in Washington is just explain to people that Bitcoin is just an improvement on gold. It's not just an improvement on gold, but it's a great, if you know nothing about Bitcoin, I think that's like a great jumping off point. It's just gold that you can email. And so the system has had no problem with a permissionless bearer asset being a keystone of its economy, and I think Bitcoin is just sort of the logical conclusion of that. It's just the upgrade.
Yeah, and I'm going to add one other thing there, Robert. In answer to your question, I mean, it's very interesting when you talk about, will the asset class be integrated to the existing financial system or exist outside of that, because that was its sort of core ethos. And when people talk to me about that, or they talk about the unhosted universe versus a custodian universe, whatever it might be, to be completely honest, I think that both need to exist. They need to exist because they have different purposes and different objectives. One needs to respect the other. If it's really going to be an industry that's going to service a mass population, you need to have both. The danger becomes moving away from a convergence, or we call it a convergence of standards, or an interoperable way that in our example, a bank can offer exposure and integration to the Bitcoin ecosystem with additional whatever hardware devices for signing methodologies or anything. We can include all of that stuff from a privacy and control perspective. But what we want to avoid is saying everything needs to operate in a regulated environment and the unhosted space is completely illegal. That is an extremely dangerous conversation and starts to create this almost like two-tiered system or two separate ecosystems that can't interoperate. One needs to respect the other, and the custodian universe, if we put the Xapo bracket, needs to understand how to manage a risk that allows us to interoperate with the unhosted space and vice versa. It can't be that we end up with this massively weird two-tiered system where everyone starts to move things into completely unregulated environments and creating sort of the not so good ecosystem developing there, and this sort of regulated environment creates a completely separate tier where the regulated universe can interact with that. That also doesn't work. So interoperability, convergence of standards, bringing those two places together, that's the key, whilst both respecting the other because they need to exist in different environments. My mother is not going to obtain a ledger device and put her life savings into some safe department where in risk of a whatever fire everything melts away and everything is lost. She doesn't understand the security mechanisms around private key management or anything like that. She might also want to appoint her daughter and son as beneficiaries to the assets that she holds, and she needs to do that within a proper structured arrangement where those assets are looked after for her. Now, that's not perfect. Vice versa, if I'm domiciled in Argentina or Brazil and I have incredible concerns around the government authorities and their powers of enforcement and seizure over my assets, I don't want to hold it on my bank account and I want to maintain complete sovereign control over those assets. And that also needs to be respected. So, both universes or tiers need to interoperate and exist. That's my view.
Yeah, I mean, I completely agree, and Xapo obviously sits perfectly in those two worlds. And I had Seamus, CEO of Xapo, on my show, and we discussed this. And I think he made such a great point. The self-sovereignty ethos of Bitcoin, at least particularly in the early days, has always been sacrosanct. But as he said, Bitcoin will get to a price where you'll get the cold sweats by trying to look after it yourself. And I think there are plenty of, as you say, there are different situations in which you want to hold it yourself and situations in which you would want someone trustworthy to hold it on your behalf. But I mean, we are perfectly on the note of the evolving Bitcoin ecosystem and Bitcoin evolving in terms of how we see it. And there's another thread I want to pull here. Connor, I'm going to come to you with this. So January 2024, we saw the US spot Bitcoin ETFs launched. This was undoubtedly a very large moment for a number of reasons. But one question it has kept raising is about how people are interacting with Bitcoin, whether getting exposure to Bitcoin through an ETF is ever preferable to owning the asset yourself. What do you make of this?
Yeah, I think that ultimately Bitcoin is a tool that exists to serve many different people in many different forms. And I thought that, the release of the spot ETFs and, what we saw was that is the fastest launch of a financial, or the largest launch of a financial product, the most successful financial product that was ever launched was the IBIT ETF. And, what does this mean for individuals? I think it all comes down to choice. Like, you now have another choice of how you can get exposure to this asset. For a long time, the public markets themselves were gate kept by a handful of people. If you wanted to get exposure to the stock market, it was actually a pretty difficult thing to do in the 70s and the 80s. And with the advent of ETFs, with the advent of indexes, then a whole new class of people were able to get access to the returns that were being really just held to a small number of sort of high net worth individuals and financially connected people. And so I saw and still do see this new class of ETFs as just another choice that people have. The reality is, our financial system has so many different bureaucratic carrots and sticks and all sorts of different rules on who can get exposure and how they can do it, that adding another choice to that lineup is always going to be a net good. And I think that's the example of what good policy can look like, is you are taking restricted assets and just giving them, these assets, they want to flow. The financial capital wants to flow, and that is what really makes the West stand out, is its deep and liquid capital markets. So I do think this raises important questions. People all the time are saying, does this change Bitcoin's principles or ethos? And I view this as it's an individual decision of whether or not you get exposure directly to Bitcoin and cold storage, or you get it through an intermediated financial product. But the through line is that none of that changes the protocol itself. None of that is changing the guarantees of Bitcoin, that if you do hold it in self-custody, for a fact there's only ever going to be 21 million, and you are not trusting anyone but the cryptographic primitives and the math underneath the entire system. And that assurance doesn't go away. What changes is just the trust model of the products on top of it. And I think as long as people understand, what the trust model is in any scenario, no matter what, if you're holding it in self-custody or holding it through an ETF, there are different types of risk. And there is never going to be a way to live in a risk-free world or have a risk-free exposure to Bitcoin. It's just the nature and character of them change. The responsibility shifts from yourself to someone else. And I think that just having choice, having access to as many different options along that spectrum is a net good for everyone.
Yeah.
I
think go on, David, sorry.
Oh, sorry. I would add that I think with a caveat to what Connor said, like, choice is great as long as people are educated about those choices and the trade-offs. And I love your point of, like, there is no way to hold Bitcoin without risk. It's just a question of what risks you want to take. I think, one thing I've noticed is that, like, the rise of the Bitcoin ETFs have led to a whole new class of Bitcoin holder who are almost abstracted away from some of the underlying points of Bitcoin. And so I think what the ETFs are awesome for is getting exposure to the price of Bitcoin. And it's great for sort of protection, for, it's harder to, you can't wrench attack basically, an ETF holder. It's in some ways easier for, like, inheritance and things like that. But really, that price of Bitcoin comes ultimately from Bitcoin's utility, or speculation about Bitcoin's utility. And that utility is sort of only accessible via self-custody. And so I think it's important for people to understand that, the ETF might be a wonderful way to, get exposure to the price of Bitcoin. But in the scenarios where Bitcoin was, really envisioned for, not your keys, not your coins is an important trade-off and an important thing to keep in mind. And it's why so many sort of things like hybrid, custody models, I think, are really interesting, where, you don't have to give up that self-custody, but you can have help from an institution to custody. And I think companies like Xapo kind of do a good job of sort of trying to strike a balance between, the poles of just having an ETF proxy and then having your private keys that you manage entirely by yourself.
Yeah, and just to add to that, and I agree with that. I think that there are a couple of other interesting bits. So price exposure through an ETF doesn't actually allow you access to the network and what it was built to do. It was initially built as a payments network. Depending on where things go, depending on how volatility plays out and how price flattens in the future, could the network become that, depending on what happens with USD and stablecoin infrastructure, et cetera, we don't know. But access to the actual network, you'll never obtain through a wrapped product. The other thing about wrapped products that sometimes people don't fully graphs from the beginning are the pricing models, right? So if you had bought the grayscale ETF, the original ETF, back in the day at like 2.5% or whatever it was, now it's at 1.49 or whatever it is, and the BlackRock IBIT are around 25 bips or whatever that is. Doesn't sound like a lot of money, 25 bips or 1.5%, but run the models of what $100,000 investment in Bitcoin 5 years ago would have been with a 25 basis point cost against the structure that you're holding. If you follow the price of BTC and you believe in the future and where that price could hit in another 3, 4, 5 years, those fees are not insignificant. So, $100,000 investment would have cost you like $67,000 to hold through a wrapped structure with that kind of pricing model if it had followed the increase in price that we've seen in the last 5 years. And sometimes people don't fully understand that either. So they look at the product, they think, hey, great, the counterpart to my exposure is BlackRock. That's a big, reputable company. That's wonderful. But they don't actually look at any of the intricate details, i.e., what's the functional purpose of exposure to this price, and two, what's it going to cost me if things go the way that it can. Is that really the way that I want to do this? So I don't think the real core Bitcoin community will ever look at sort of wrapped exposures to the network. That's my view.
Yeah, it's interesting, and how I've always seen it is it's likely an ETF is likely preferable to buying Bitcoin on an exchange and holding it on the exchange, which I think is what a lot of people do. But as Connor said, it's almost like pick your risk, and just be comfortable with that. Look, we only have 5 minutes scheduled left. We can probably overrun a little bit. I have lots of things I wanted to get to that I haven't, so maybe we need to reschedule this for like a 2-hour session. However, I wanted to get to questions from the audience because they've been kind enough to spend their time with us and they've asked some really good questions. Joey, I'll come to you first. This is a question we've touched on, but perhaps you can make it briefly explicit. The question is, what are the pros and cons of storing Bitcoin at Xapo Bank versus self-custody in a multi-sig cold wallet?
Yeah. So what are your objectives? If it's a question of security, so let's think about some bad case examples, really, really bad case examples. The kidnappings reported across France, all of the kind of nasty stuff. So we have part of our security infrastructure, these nuclear vaults in the Swiss Alps, etc. So vault infrastructures, even on the basis of a hack or a loss or something device, it takes 48 hours, I think it is, for a transaction to be executed out of that vault. So the security layers that you can build into the custody relationship, you can't build into that kind of infrastructure. The inheritance piece I mentioned briefly before, if you have like kids or family that you want to leave, that entire placement can be in place within something like a Xapo infrastructure. Also, from a security perspective, you got to understand, again, this is that point of not all VASPs operate in the same way. BTC that you hold within a Xapo account is completely off balance sheet, held in insolvency remote structures. So even in catastrophic worst case scenarios at the business level, your assets are absolutely secure and will remain to be your property. Those are the big time positive. Plus, we use that term, superpower your BTC. So you have the asset, you own the asset. What do you actually want to do with it? Do you want to put it to work in the market for you? Fine. Do you want to invest it in a tried and tested deployment strategy, earning a Bitcoin denominated yield? Fine. We've built that option for you as well. Do you want to borrow against the value of the BTC in a secure, structured way where the USD that you receive is literally put on your bank account? Also built into the product and service. So the powers that you're building to use the asset that you own are much more significant in that environment than what are the downsides? Absolute reportability, control, enforcement powers are much easier to execute over a custodian than any sort of self-hosted structure. But there are kind of flip sides to that as well, and I'll say them very, very quickly. If you own assets in a self-custody structure and one day you want to buy a house or one day you want to buy a car or whatever it is, you are going to have a touch point to the fiat world. I mean, I don't think anyone's going to contest that. Historically, that was more possible as matters as the world develops with the more complex things like CARF and all the global reporting frameworks that are coming into effect. We're going to get more and more into a system where you will have to interact with that financial services world. We build it together under one umbrella. If you're not in that umbrella, there are other risks that you will have to understand how to manage yourself. And that's something that is developing as time progresses. But that's as short an answer as I can give on that.
Yeah, no, it's a good answer. And there's a lot of interesting points there. Certainly don't talk to me about Bitcoin and buying houses. They wouldn't even factor my holdings in when I was getting a mortgage for my first house, despite it being a decent percentage of my net worth. Anyway, I think the other interesting thread there is Bitcoin becoming a productive asset, which has been a real trend in the past year or two. It's been a conversation that a lot of people are having. And we do have another question from the audience about that. Connor, I'm going to put this to you. Can you envisage a time when institutions or banks will pay a dividend interest to whole coiners to park their Bitcoin in their vault, not like staking, but like the high yield savings accounts of the past?
It's a great question. So people have tried this already. I think they will continue to try this forever, which is the concept of give me your coins and I'm going to go and do some genius financial engineering and obtain some yield on it, and come back to you. And you're not only going to have your Bitcoin, but you're going to have, Bitcoin plus XYZ. That is a tale as old as time. People will try it to varying degrees of success. We've seen companies like BlockFi and others blow up on this exact premise. And I think that we will see it at varying levels of success and failure. So, you can think of BlockFi as like, I don't know the size of the company. Maybe it's like $1 billion company, maybe it's a couple $1 billion, but it wasn't like true major financial institutions. I think this will continue to be a product that, we're seeing major banks get involved in. It would not surprise me if, really, really large financial institutions a few years from now decide that they're going to make some sort of Bitcoin yield product. At the end of the day, you have to remember, there are only 21 million Bitcoin. What makes lending possible with traditional fiat currency and the ability for them to pay interest on your deposits indefinitely is that the money supply itself can expand. And so there is a flexibility to pay yield to people that are holders of the currency through credit expansion. Bitcoin does not have supply expansion. And so any sort of scheme to pay you yield on your Bitcoin is going to necessitate taking that Bitcoin from someone else in perpetuity, as long as you're getting paid that yield, and then being successful at that. And the fixed nature of Bitcoin makes it incredibly hard. So, maybe there are some fantastic opportunities. I think that as Bitcoin continues to monetize, as it fully comes into a global store of value, a multi-trillion-dollar asset, then maybe those will be viable. We've certainly had free banking eras in the past that just had a scarce asset, a scarce capital asset like gold, underwrite the book of the financial institution, and then banks paid yield on top of that. Many of them went bankrupt. Some of them were successful. It is a tale as old as time. They will do the same thing with Bitcoin. Again, it goes back to like understanding the risk. If anyone is telling you, yeah, you can just park it with here and you're going to get Bitcoin plus yield, you have to always ask the question, but where does the yield come from? And if you don't have a very compelling understanding, a very compelling reason of where it's coming from, and you don't feel comfortable, where it's not clear to you where the risks are being taken and explicit on what the potential downsides are, then it's a scary proposition. I mean, in my mind, the best thing is just a custodial arrangement where you're actually paying some very, very small fee to just have, like, I would feel better of the arrangement that's more like, I'm just going to park my Bitcoin and pay for that fee in the same way that if I want a storage unit to store my rare collectibles or my artwork, then I just pay a small fee and I feel comfortable on getting best in class service. And there are some things, some caveats to this. Lightning has this ability to earn yield on liquidity you're providing to the network. There are some things that provide yield, but I think in any meaningful sense, at any meaningful scale, it is going to involve some level of risk. So I think, again, it's just a question of managing what risks are you taking on and how deeply you understand what the true downsides could be.
Yeah, absolutely. The first wave was particularly bad for that sort of thing with rehypothecation and so on.
There's also a massive lack of understanding around the risk. So, we've paid 1%. We now pay like 0.5% on BTC savings account up to 2 BTC, but we don't touch the customer's asset. It's effectively a yield that we pay, but there's no touch point to the customer's asset. But I'm saying that because the question we'll get back is, yeah, but why don't you pay 5%? And we've developed a fund product that's tried and tested and will generate a yield of circa like 3%, and it's incredibly conservative in the way that it's deploys and earns that yield wrapped within a fund structure. But the question we'll get back from sometimes is, yeah, but there's another fund that pays like 8% or 15%, and you're like, well, but you have literally no understanding of the level of risk you're exposing to, but on a savings account versus fund deployment strategy A versus really aggressive strategy B. There's a very, very significant lack of understanding. And I'd say that's pretty classic in the financial services world. In the crypto world, it's like 50x more critical to understand that before you make any form of deployment or expose yourself to anything like that. Yeah.
Yeah, absolutely.
You don't know where the yield is coming from. You are the yield. That's the one-liner to just always remember.
It is. Okay, look, 2 more questions. We are obviously, we're already out of time, but I've been told we have a maximum of up to the hour. We've had one question in the chat from Michael Parsons. I'm going to do that first, and then David, I'm going to come back to you for the final question. I can answer this live. Does that bring that on screen? I'm not sure if that brings that on screen or not. Maybe people can say that. But this is really for you, Joey, because it's Xapo products. Michael Parsons has asked, does Xapo intend to offer corporate accounts for, say, UK and Gibraltar companies?
Yes, that's a one-line answer. But we're not running business accounts. They're not transactional-based accounts. We can call it almost sort of corporate treasury management. So absolutely, yes. Historically, I can talk about this because it's public information. We did offer that in years gone by. We sold our institutional business to Coinbase around 2019, entered a 5-year non-compete with them to not service those kinds of accounts in that way. And that was the switch off. It was, I think, around 900,000 BTC in custody we sold as part of that transaction. We're re-engaging in that now. So we have a team of people led by Tommy and a series of RMs that are developing that now. It is very selective and careful, but so not business accounts, but yes, corporate accounts. So, yeah.
Okay, excellent. Okay, final question. David, this is coming right at you. This is a real throwback question to the start of this conversation about what Bitcoin is and how we use it, how we interact with it. The question that's been asked is, how is Bitcoin going to make it as everyday money, given that most countries on Earth tax it with capital gains?
That is a really good question. How is Bitcoin going to make it if it's treated as capital gains? I think a de minimis, exemption is kind of been the North Star for the sort of policy kind of fight in America. And I think we have to see stuff like that for this to work. I think my main point that I would make to the person asking this question is that, the relationship between law and sort of society does not just kind of flow in one direction. There is sort of a bidirectional relationship between the state and the people. And so I think that when more and more people use Bitcoin as money, that can change the outlook of lawmakers. And so I would just say, this is kind of why I think education advocacy is important, but it's also why adoption is important. It's why it's so important for, for example, there's a guy who works here at PubKey DC. For those who don't know, PubKey is like a Bitcoin bar. They started in New York. We now have a location in Washington. It's actually where the Bitcoin Policy Institute is headquartered. So I'm currently phoning in from the back of a bar, basically. And there's this guy who works at PubKey, Trey, and I'm just going to shout him out as an example. Uh, when Cash App launched their sort of pay with Bitcoin feature, Trey single-handedly onboarded like 100 merchants in DC, just pounding the pavement, like going to people and saying, "I want to buy your sandwich. I want to buy your boba tea. I want to buy your coffee, but I don't want to pay you in dollars. I want to pay you in Bitcoin." And there's a way that you can do that. And he just literally singular person, one Bitcoiner on a mission. And now basically all the places that I go and spend money in DC, I have the option to use Bitcoin. That creates a sort of reflexive cycle. The argument has always been, well, no one's using Bitcoin as money. No one's actually buying coffee with Bitcoin. Now there are thousands of merchants across the United States alone who do allow you to pay in Bitcoin. And so, yes, I think that is a really good point. That, like, in the long run, the kind of capital gains tax treatment of Bitcoin, and I'll just stick to the United States because that's what I know best. That framework, as it stands in the United States, has to change. There's lots of debates about the extent of that change. Should there be a cap on and how much you spend annually? People have talked about a per transaction limit. There's kind of an infinite number of ways to slice it. But I agree with the sort of central thrust of the question, which is that we have to have a tax treatment of Bitcoin that recognizes its dual use as both a store of value and a medium of exchange. And I guess the hope that I see is that educational efforts like ours, coupled with real world adoption and Bitcoiners going out and onboarding merchants, that creates pressure to create change. And so I think the more people who use Bitcoin as money, the harder it is for the state to ignore that. And you might think, oh, well, why does the state care? Well, small businesses are a massive constituency for governments. And right now, small businesses absent Bitcoin are forced into a really predatory duopoly where Visa, MasterCard, Amex are taking a huge rake in notional terms on every single transaction and sale that they do. And so I think once merchants realize that, for example, PubKey offers you a discount if you pay in Bitcoin, and it's just because they don't have to pay the fees. So I think when people start using Bitcoin more as daily money, and when you've got merchants saying, hey, I keep more of the profits from my business when a customer pays me in Bitcoin, if that cycle of adoption continues, it becomes harder to ignore. And so I am sort of hopeful that sort of we see the law react to society's choices. But I think that's the key thing to keep in mind, is that we aren't just recipients of the law. Like, our actions, our preferences put pressure on the state and ultimately can shape legislative outcomes.
And just to put a tangible point on that of what we do in DC and how this has shown up in our work, we've been actively talking to Capitol Hill. There's active discussions about a crypto tax package, and this concept of a de minimis exemption for small everyday payments has kept coming up. And we were talking to members of the tax committee about this, and they said, I guess it sounds like a good idea, but I don't know anyone that uses this for payments. I've never used it for payments. Why should we care about this? And we actually went to the recent research by the Federal Reserve, of all people, and it had actually done a survey and had found that something like 8 million Americans had used Bitcoin, other digital assets for payments in the past year. And those numbers coming from official agencies and basically showing them the real-time usage is worth its weight in gold. And that was sort of that statistic was a critical unlock for us to be able to properly educate these members of Congress about what is actually happening out in the real world and how many people are using this as a financial tool that might not have access to traditional bank accounts, or they're just underserved by the traditional banking system. So it really does. I think that the everyday usage of Bitcoin as money does allow for the everyday usage. It is sort of this positive feedback loop. And as the network continues to grow and people continue to be onboarded, then we'll have even better sort of resources to point to and say, hey, this is a real phenomenon that's happening. And it really matters for you to get this right in policy.
Yeah, absolutely. I think it's somewhat a minority now still, but in plenty of places it isn't. And I've had a lot of very interesting conversations, for example, about townships in South Africa, where it is the only money that's being used. So yeah, I think you're right. By using it, we are bringing about the right policies behind it. Okay, I've got 1 minute to wrap, or I think I'll be in trouble. Joey, David, Connor, thank you so much for joining us. That was genuinely a fascinating conversation.
Good stuff. Really enjoyed it. Thanks for hosting us, Robert, and David, Connor, for making it. Really enjoyed it. Good stuff.
Yeah,
Thanks,
thank
Robert.
you all, and great to meet you, Robert.
Thanks, guys.
All
Thanks,
right.
everyone.
Bye.
Thanks, guys.